Welcome to CoreLogic's housing market update for October 2021, brought to you by onthehouse.com.au. CoreLogic's National Home Value Index rose another 1.5% last month, taking Australian housing values 17.6% higher over the first 9 months of the year and 20.3% higher over the past 12 months. The annual growth rate is now tracking at the fastest pace since the year ending June 1989. The monthly change in housing values remains positive across every capital city and broad rest of state region, with Hobart and Canberra recording the largest growth, while Darwin and the recently revised Perth Index recorded the softest growth conditions across the capitals. Across regional Australia, regional New South Wales, regional Tasmania and regional Queensland led September's capital gains. Although growth conditions remain positive, it is becoming increasingly clear the housing market moved past its peak rate of growth in March, when national dwelling values increased by 2.8%. Since that time, the monthly rise in values has eased back to 1.5%. The slowing in momentum can be attributed to higher barriers for non-homeowners, along with fewer government incentives to enter the market. With housing values rising substantially faster than household incomes, raising a deposit has become more challenging for most cohorts of the market, especially first home buyers. Sydney is a prime example where the median house value is now just over $1.3 million. In order to raise a 20% deposit, the typical Sydney house buyer would need to raise about $262,300. Existing homeowners looking to upgrade, downsize or move home may be less impacted as they have had the benefit of equity that's accrued as housing values have surged. The slowdown in first home buyer activity can be seen in lending data, where the number of owner-occupier first home buyer loans has fallen by 23% between January and August. Over the same period, the number of first home buyers taking out an investment housing loan has increased, albeit from a low base, by 43%, suggesting more first home buyers are choosing to rent-vest as a way of getting their foot in the door. Despite worsening affordability, house values are still generally rising faster than unit values, a trend that's been evident through most of the COVID period to date, especially across the capital cities. Hobart and Darwin are the only capital cities where this trend has not occurred, with unit values rising 5.4 percentage points and 4.8 percentage points more than house values, respectively, over the past 12 months. The reason for this outperformance of the Hobart and Darwin unit markets looks to be quite different. In Hobart, demand is skewed towards a slightly older demographic that may be looking to downsize or looking for lower maintenance housing options against a backdrop of scarce unit supply. In Darwin, the unit sector has moved through a long-running oversupply that has driven housing prices lower. While the median value of a unit in Darwin is the lowest of any capital city, unit rents have surged 20.3% higher over the past year, driving gross rental yields to 6.9%. The stronger performance of house values relative to unit values is less obvious outside of the capital cities. The differential between annual house and unit growth rates in the combined capital cities was 12.3 percentage points in the 12 months to September, compared to a 1.9 percentage point difference across regional Australia. In fact, the September quarter saw unit values rising faster than house values across regional Australia. This is probably a reflection of stronger demand for downsizing options and holiday homes in popular coastal markets. Persistently low advertised supply remains a key factor placing upwards pressure on housing values across the country. In a positive sign, the trend in new listings added to the marketplace is now rising, albeit from a low base. Nationally, based on a rolling 4-week count, the number of new listings is up 28% since the recent low point in early September, taking the trend in new listings 3% above the 5-year average for this time of the year. Although new listings are ramping up, the trend in total active listings remains extremely low, continuing to reflect the rapid rate of absorption seen amidst high buyer demand. Nationally, total advertised supply levels are 28.1% below the 5-year average, and every capital city is recording a below average amount of advertised supply. While inventory levels remain low, the number of home sales is well above average. CoreLogic estimates the number of dwelling sales across Australia was 25.5% higher than the 5-year average and 41.9% higher year on year at the end of September. Such low levels of available supply, along with high demand, is keeping selling conditions skewed towards vendors. Nationally, homes are selling in 35 days, up from 29 days in April, and vendor discounting levels remained around record lows at 2.8%. Another factor pointing to strong selling conditions is the bounce back in auction clearance rates as restrictions relating to one-on-one property inspections were eased mid-month across Melbourne and Canberra. By the end of September, the combined capitals clearance rate had returned to 80.5%, its highest level since late March. Melbourne housing market conditions have been consistently softer than the capital city average, with housing values rising 0.8% in September to be 15% higher over the year, which is the lowest annual growth rate across the capital cities, but still the highest growth rate across Melbourne since 2010. The unit market has been a drag on the headline growth rates, with unit values up 8.3% over the year, compared with an 18% lift in house values. Across the subregions of Melbourne, the Mornington Peninsula stands out with the highest annual rate of gain at 31%, followed by Melbourne's Outer East, where values are up 17.6%. The softest subregions have been in Melbourne West and the inner city, where housing values are up 9.4% and 10.4% respectively. As the spring listing season gathers pace, new listings being added to the Melbourne market are now tracking 18.3% above the 5-year average, and total listings are now 2.9% above average. Higher stock levels could take some further heat out of the market over the coming months. Overall, housing trends around Australia remain positive. Growth in housing values is being supported by an expectation that mortgage rates will remain at record lows for an extended period of time, while strong demand is occurring alongside persistently low advertised supply levels. This dynamic is changing as the barriers to enter the housing market become higher. Raising a deposit and funding transactional costs has become a significant challenge for some sectors of the market, especially first home buyers who haven't had the benefit of home ownership as a source of wealth. Another emerging risk factor is the potential for tighter credit conditions. Through late September and early October, we saw the Federal Treasurer endorse tighter credit policies for home lending. This is consistent with commentary from the Reserve Bank and APRA that they will be focusing on the quality of lending standards and trends in household debt. In the year to June, the RBA data showed housing credit increased by 5.6%, alongside national accounts data showing an income increase of just 1.6% for the same period. Additionally, APRA reported that home loan originations with a debt-to-income ratio of at least 6 comprised 22% of home lending in the June quarter. It's looking increasingly likely that any new credit restrictions will focus on minimising further accrual in household debt, specifically the housing component of household debt, or the lifting of minimum interest rate serviceability assessments. A further trend to watch will be how consumption patterns are impacted by a post-lockdown environment. High savings rates have likely been one of the key factors adding to housing demand throughout the pandemic, with the household saving ratio jumping to 22% through the June 2020 quarter amid harsh restrictions. With 70% vaccination rates triggering greater freedoms across parts of the country, households may return to more normalised pre-pandemic consumption patterns and spending, which could ease housing demand. Additionally, the coming months are likely to see advertised stock levels move higher. The spring selling season has been delayed to some extent by lockdowns in Sydney, Melbourne and Canberra. However, the recent trend has shifted towards a rising number of new listings. As demand becomes more constrained from worsening affordability and potentially tighter lending conditions, advertised stock levels may start to normalise over the final quarter of the year. This could take further heat out of the marketplace as buyers benefit from more choice and less urgency. Despite the potential headwinds to house price appreciation, monetary policy remains accommodative of high housing demand. In its latest board meeting minutes, the RBA reiterated the cash rate was unlikely to move higher until 2024. Market momentum remains strong, with monthly growth in housing values nearly 4 times the decade average of 0.4%, while indicators suggest it's still very much a seller's market. It looks like there are plenty of trends to keep an eye on throughout October. We'll have our next update out in early November, but in the meantime, you can keep up to date with the flow of housing market research at CoreLogic.com.au.